Hey folks, I'm best-selling author of The Power Zero, David McKnight. In today's video, you'll see part 2 of my interview with podcast host Jesse Wright, in which we discuss the misleading nature of IUL TikTok videos, as well as what you should really be looking for in a financial advisor.
Right. I mean, the main question you have to ask yourself from your book is, do you think taxes will be higher now or when you are drawing the retirement? And I think most people would say they're drawing the retirement. Then one thing, researching was if you're talking about those tax postponed accounts, tax deferred, whatever terminology you want to use, is that once you reach the age of 70 and a half, they make you automatically withdraw money, a certain percentage every year, which of course is creating a tax event every single year. So if the market's tanking and you're drawing money out, I mean, you could really, you talk about the different risk sequence of return risk, withdrawal rate risk, inflation risk, longevity risk. And of course, as you talk about in the book, longevity risk amplifies or magnifies all these other risks.
Right. So you bring up a great point. They've actually recently updated that RMD to age 73. But here's the point. Only about 20% of Americans are going to be forced to take that money out, because 80% of Americans are relying on that money. So they're probably going to be taking more than the RMD out anyway. But you've got a great point. If you're forced to take that money out when the market is down, what they're doing is they're forcing you to sell low, right? Which is the opposite of what we've been told to do, which is buy low, sell high. They're now forcing us to sell low, which occasionally they will show some deference in that regard, like during the COVID-19 massive drop in the market, they allowed people to postpone their RMDs. So in their infinite goodness, they do allow for those types of things occasionally. But you're right. If it's not a pandemic and the market goes down and you're forced to take that money out, yeah, you're liquidating shares while they're down, which is a sequence of return risk, which is what I talk about in my book, Tax-Free Income for Life. So for sure.
In both your books, more in your second book that you just mentioned, you talk about the LIRP, which was it life insurance retirement plan. And then it seems like recently, at least in my fiance's social media feed, she keeps getting all these IULs, which is the indexed universal life insurance. You talk about that as well in your book as a strategy. I mean, what's the strategy with life insurance?
Well, most of what you see on social media, unfortunately, is wayward life insurance agents who are employing pretty despicable tactics. I mean, basically, I'm a big fan of taking advantage of every nook and cranny in the IRS tax code. I love Roth IRAs. I love Roth 401ks. I love Roth conversions. I love taking money out of your IRA up to standard deduction so those RMDs can be tax-free. I think that the LIRP or one kind of LIRP's index universal life can be used in certain contexts and be very powerful as a complement to all of those other tax-free streams of income. But anytime you see someone on social media who start beating up on a 401k or even a Roth 401k, I mean, the other day I saw someone say, hey, I don't care if you're getting a match in your 401k. You should take everything that you're otherwise putting into your 401k, cancel out your 401k, cash it in, pay the tax, pay the penalty, and take all that money and put it into an index universal life policy. I mean, that, first of all, that's like financial malfeasance to tell someone to do that. But second of all, it makes index universal life out to be some sort of a silver bullet panacea type investment, which it's not. It's only designed to give you exposure to the stock market up to a cap with a guarantee that you won't lose any money. I mean, you should expect to get between 6 and 8% gross rates of return over time. It's not a replacement for the stock market. The stock market over time is going to give you closer to 8 to 10%. So the IUL ends up being sort of like a bond portion of your portfolio. It's not a stock market replacement. The other thing that I love about the IUL is it gives you a death benefit that doubles as long-term care. So one of the reasons why people hate traditional long-term care insurance is you're paying for something you hope you never have to use. And if you die peaceful in your sleep, never having used it, they don't send you all your money back at the end. It goes to pay for someone else's long-term care benefit. With the IUL, if you die peaceful in your sleep, never having needed long-term care, someone's still getting a death benefit, probably your kids or your grandkids. So there isn't that sensation of having paid for something you hope you never have to use. I would say 99% of the videos on TikTok are misrepresenting what the IUL can do and misrepresenting the role that the IUL should play in your retirement portfolio. I feel like I'm one of the few lone voices in the wilderness that is telling people to use the IUL, but to use it in a measured sort of a way and only as a complement to Roth IRAs, Roth 401ks, Roth conversions, so on and so forth. So the IUL can have a place. Do I have cash value life insurance? Yes. Every one of my kids has cash value life insurance. My wife has cash value life insurance, but it's a complement to all of the other things that we're doing. It's not, it's not the main cog in my retirement plan. So I just think people got to be very, very careful about what they see on TikTok. These people, they have one license. They have a life insurance license. They're not what we call fiduciaries, so they're not required to do what's ultimately in your best interest. And so there's some really despicable stuff going on out there on social media. So I would just encourage people to take all of that stuff with a grain of salt.
What also seems like for the IULs, they focus on the concept of like infinite banking or being your own bank side of it. But from some of the research I've done, you have to wait a decade to even be able to take out a loan against it with a 0% interest anyways. It's not like you get an IUL and then the next day you're taking out, $100,000 loan and buying a new car or something like that.
Yeah, the IUL is a long-term proposition. And I wrote another book called Look Before You Lerp, where I sort of talk about the IUL and the types of things you should be looking for in an IUL. An IUL is a long-term proposition, sort of like getting married, right? You're keeping it until death do you part. It's not a short-term proposition. It's not a savings account. I don't typically recommend it for, infinite banking is not my sweet spot, so it's not something I ever talk about. But I understand all of the issues that you're describing, which are basically that you have to let that thing marinate for a period of years before it can start operating in the manner in which these agents are describing. And there's a number of life insurance companies that have basically put out communiques that say, look, we're no longer accepting business under this, infinite banking framework because it's just too complicated. It's not why these life insurance policies were created in the first place. They're co-opting these policies to do something that it wasn't really intended to do. So I'm not necessarily bashing the people that use it, but there's a lot of different complications that arise when you want to have it operate in the manner in which these advisors or agents are trying to get you to operate them.
So that brings us to the word trust. There's so many different product services out there we've talked about, and I think elderly people, people more mature in life, people are always targeting them because, of course, they have money since they've had the whole life to accumulate it. And then there's so many different services that have so many different technicalities and complexities, and I would even say they're convoluted. You need an expert on Medicare. You need an expert on Social Security. You need an expert to do a Roth conversion, life insurance policy. I mean, how do you even find someone that's trustworthy? And there's so much information, especially with social media, as you're talking about. I actually saw the video that you critiqued. And just looking at that guy, I don't trust that guy for a millisecond.
Yeah, I mean, you've really got to ask around. I mean, you can go online and say there's lots of different questions that you can ask a financial advisor to see if there's somebody you want to hand your life savings over to. But really what I try to tell people is, look, it's really important to get to the 0% tax bracket. It's really important to shield yourself from the impact of higher taxes. But you probably don't want someone who has never, ever led somebody to the 0% tax bracket before, because there's lots of pitfalls that stand between you and the 0% tax bracket. So if you're dealing with a neophyte, someone who has never really done it before, then they're experimenting on you. And who's to say they're going to get it right? Of course, in our network, we've got trained, vetted, qualified, Power of Zero certified advisors that have been trained, vetted, qualified personally by me. They've led dozens and dozens of people through this process, in some cases, hundreds of people through this process. So you really want someone to, I always like to, if somebody has an advisor, I say, a lot of times they'll say, hey, Dave, how come my advisor has never brought this stuff up to me? And I'll say, well, there's one of two reasons. Either they don't know about it, or they know about it and they haven't told you about it. And frankly, I don't know which one's worse. So you want someone that is, number one, acquainted with the fiscal landscape in our country, understands that tax rates down the road are likely to be dramatically higher than they are today. And number two, understands all of the shifts that you need to make between your buckets between now and when tax rates go up for good. They're going to put you in a position to be shielded from higher taxes down the road. And if they're a fiduciary, which means they're Series 65 licensed, that means they're required by law to defend, to uphold the recommendation that they gave to you in a court of law. So being a fiduciary is a pretty big deal. And so those are the types of things I would ask people to look at.
You mentioned in your book talking about the 401k that you should basically take as much as your employer is willing to match because, of course, it's 100% return, as you mentioned in your book and your documentary. But what's your recommendation? Would you put any more money than what they're willing to match into that? And then would you just open a Roth IRA as you're paying that tax? So you pull that money out tax-free? Like, what's the strategy with the 401k?
Good question. So most Americans have access, it's probably 80% of Americans have access to a Roth 401k through work, which is great because that allows you to put $22,000 this year, $22,500 goes up to $23,500 in 2024, but $22,500 per year into your Roth. If you're over age 50, you can put another $7,500 per year into your Roth 401k. Plus, you now have the ability to have the match allocated to the Roth portion of your 401k. So, I mean, if you think about it, let's say you and your spouse have Roth 401ks at work and you want to max them out and you're over age 50, that's $30,000 for you, $30,000 for your spouse. And if you're each getting, say you're getting another $5,000 in a match each, so that's $70,000 that you have directed towards your Roth 401k, which is just huge. I mean, that's a massive amount. You could really build a huge tax-free nest egg over time by just taking advantage of your Roth 401k. And then on top of that, if you're below the modified adjusted gross incomes, which this year is $228,000 for a married couple, you can also contribute to your Roth IRA, which is another $7,500 for you, $7,500 for your spouse. So that gets you up to like $85,000 of tax-free income. And then if you still want to put money away, you can start taking advantage of some of these IULs and maximum funding those so that, these are, you're buying as little insurance as the IRS requires of you. You're stuffing as much money into as the IRS allows in an attempt to sort of mimic a lot of the tax-free benefits of the Roth IRA. So you're got this strategy that incorporates 4 or 5 different streams of tax-free income, which is really a balanced and comprehensive approach to tax-free retirement planning. So that's really the approach that we try to recommend.
What would you say to a financial planner that's telling you that since that you're in the 401k or IRA, it's tax deferred, so you theoretically have more money to put into it now, and they're saying since you're putting more money into it now, then if you're putting taxes on it, having less money to put into a retirement account, that over the years, that money will grow so much more. What do you say to that?
It's growing more, but it's growing on the IRS's letterhead. So remember, when you get that account on your 401k, it looks like it's coming on your, like a TD Ameritrade or a Schwab letterhead. That's really the IRS's letterhead because the IRS has a stake in that money. So give you an example. Let's say you decide to go all in on your 401k and that you get a 30% deduction on the front end. So you can have $1 million in there by the time you retire. Well, by the time you take that money out, you may only net $700,000 after tax. Well, guess what? What if you instead did a Roth 401k at the outset and you're only able to put in 70% of what you were able to put in to the traditional 401k? Well, by the time you retire, you're only going to have $700,000, but that's the same as the after-tax amount on your 401k. So people forget that not all of that money that's growing in your 401k is accruing to your benefit. A portion of that belongs to the IRS. So even though the full account is growing, the IRS has a stake in that growth. So it feels like all of that money is accruing to your benefit, but the reality is it's accruing to the IRS's benefit because it's on the IRS's letterhead.
Right, and as you're basically saying too, like let's say that $1 million in 30 years when you draw it out is taxed at 40%. Well, then you got 600,000 or 50%. You got 500,000.
That's the danger of these types of accounts because it's impossible to predict how much of that money is really yours. Okay, folks, that was part 2 of my interview with podcast host Jesse Wright. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the PowerZero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified PowerZero advisor, head over to PowerZero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.